Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're just going to do a quick update on OPEC and just look at, what's happened with the OSPs or the official selling price, and where do we see demand going when we start looking at India, China, and parts of Asia. I mean, as you guys, as our loyal followers and listeners have been paying attention, we've been very cautious in terms of Asian demand as we've been following the build of crude going through March, April, May, and how April and May were really aggressive. And then we really didn't see much get drawn down, and we started to talk about why that was the case and how that's going to lead to pricing pressure, especially as we go into the shoulder season. And as anybody who watches the EIA show knows, that they will probably hate the term shoulder season by the time we get into shoulder season, which has already begun, as Labor Day is kind of that breaking point. So just jumping right in here, we're going to start off with just looking at the Saudi Arabia cut. So when we first did the OPEC Plus Supply show last week, we said the estimates were for about $1 discount, and they came in at about $1.50. Now that's changed depending on which location where things are you're seeing the discount. But here is just looking at Saudi Arabia, specifically Arabian light oil going into Asia itself. So this is the lowest Saudi oil price in 4 months, and it should have been a little bit more. It wasn't. And it's, again, going to just continue to weigh on refining, because even with this cut, we still have negative $3, $4 across the complex, specifically in Singapore and South Korea. So it's really, we're not seeing a huge turnaround. And then we look at Japan. Japan had a big build today of about 2.2 million barrels a day. Fujairah had a little bit of a draw, but again, the global builds just continue, and it's going to continue to weigh on the physical market. So when we look at it overall, when we see what has happened so far, so right now 4 out of 10 Asian refiners are saying that they're going to increase their buying from the kingdom now that they've cut prices. And again, when we have to look back and say, well, why did they do this? Again, it comes to market share, it comes to competition, and it comes to just trying to drive a certain amount of demand back to Saudi Arabian oil now that we've seen Nigeria, Iraq, and the UAE go above their levels. So again, it's just a matter of how do we get things to see some of this normalization, and you can see the problem overall, especially as we are now down below zero again. Do we continue lower? I'm going to say yes, just given where the market sits, how we bounce off the bottom. But as I said yesterday on Twitter and some of the other spots, that our first target was really kind of 37 on the oil side. Figured we'd get a bounce, and then we'd continue lower, especially as we go through the remainder of shoulder season. And the reason why we say that is when we start looking at West Africa. So right now you can see West African storage has bounced, and just based on where we're seeing new crude go into storage, not even just Nigeria, but Angola, we're actually seeing some of these spot cargoes get shifted out of September into October. We're seeing more deferrals. We're seeing a slowdown overall. So this is going to continue to creep higher. Now, Nigeria is yet to sell about 20% of crude due to ship this month. Now, that is fairly slow for them. They should be close to sold out for September, as they're already focusing on October. So that is already a bigger problem. And then when we start looking at spot versus contract, they also have a bulk of October exports that have yet to sell. So not only do they have September still to sell, but they haven't even really begun October. Now you might think, well, don't you sell out September before you go to October? Well, that's not how the physical market works. You have contract buyers, which can either opt in or opt out, usually, let's call it 60 to 90 days ahead. And they're still waiting to hear back. And we're starting to get more where they're opting out. So then you have to turn around and sell that to other places. So you could get 20% who are contract buyers who are going to opt in. So you've already sold 20% of your October slate. So that's why you can get some of these breakdowns. And then Nigeria also has multiple different grades. So you can also have one that has a higher demand based on its gravity level and whatnot. So you can see some shifts in terms of what's being sold. And then when we look at Angola, Yeah, Angola is yet to find buyers on 10% on September lots, which is actually a lot for Angola because a lot of that goes into China and settles on the Shanghai exchange, which we'll talk about in a little bit, as well as about a quarter of cargoes loading for next month. So you're already seeing that slowdown at the Angolan level. And in San Angola, they've actually decreased the price now 4 times to move some of these spot cargoes. So again, additional problems within West Africa. And just given the slate of crude that they produce, this should be essentially moving off the shelves a little bit faster. And we've seen Nigeria pricing come down, OSPs come down, which again is going to be problematic. Now, one of the smaller bright spots in Europe, we've seen Genscape has reported that things have moved a little bit lower, much closer to the 5-year average. Last month was taken up by about 34 million barrels. And here you can see, obviously, they still have a lot of oil, but you're starting to see a little bit of normalization. And again, Europe has been dumping into, specifically on refined products, which we'll talk about in a minute, into West Africa and into America. Now, it usually goes from Europe to America in regards to gasoline, Europe to Africa in terms of gasoline and some distillate. So we're starting to see a little bit more, some elevated shipments. We talked about in the EIA show last week that we expected an increase in European shipments of gasoline into the U.S., and we've actually started to see that. September, some people were saying September was going to slow down, but some of the tankers that we saw, they did get confirmed. It's not as bad as expectations, so we should see more of that show up in Pad 1 or the East Coast, and we are seeing more go into Africa. So you're starting to see a little bit of a normalization in Europe as they empty some of the tankers, the onshore tanks, but the problem is we're already getting announcements of extended downtime, which again is just because refiners just aren't going to operate at the same level, which is going to be a problem. Now, when we look at the Shanghai International Crude Oil Futures, it's important to appreciate the fact that this went limit down. Now, limit down just means that it went to the lowest level it could, and then it got stopped, which just means it no longer trades because for that day, just because the exchange has limits to create to make a normal trading environment without excessive volatility, though. In oil, we all know what volatility looks like. So here you can see that things went limit down, but then they really haven't recovered. Now, it should bounce based on what the U.S. has done, specifically today with WTI Cushing up about $1.40. But the problem here is it's really showing you the demand issue because you can see the prices came down, specifically in March. They bounced, but again, they didn't really get to the levels that we saw on the global market because they have so much oil sitting in storage, both onshore and offshore. So now we've seen an increase in distillate exports. We're seeing more of that go to Europe. So this is really reflecting what some of these physical markets are showing. Key ones being Angola and West Africa, which we've seen a huge problem with. And that brings us to Mideast crude oil pricing, because if you think about Angola, West African crude really trying to compete within the Asian market, well, nobody's really going to sit still. You have the UAE, you have Saudi Arabia, and you have Iraq that are going to continue to try to compete to maintain a certain amount of market share within the Asian continent. Key ones being obviously both India and China, but we're going to talk in a minute about some India problems. So here we can see that obviously this is factoring in the decline in Saudi Arabian crude, but Abu Dhabi has also set the official selling price of their flagship Murbain crude at a 50-cent discount to the Dubai index that we typically use as the index overall, and pricing is down now $1.35 from an 85-cent premium set in September. So you're seeing these price discounts really come in, and that's the second consecutive decline in OSPs and the biggest drop since May. So if you think about where we were in May and how those declines came down, and again, you can see the price drop. And as the prices fell, you saw China really come in and take advantage of those discounts, but we haven't seen that crude really clear. Instead, we've seen that just sit offshore and remain in that floating storage, which we continue to see in the in Asian floating storage. So here, Iraq, Nigeria, and UAE have said that they will compensate, but again, they keep saying they're going to compensate. The UAE is new to that, but in terms of just where they overproduce, so they could do it without a huge problem. But just based on that pricing action, how much are they really willing to compensate? And when you look at Iraq and Nigeria, as we continue to just beat this to death, it's just they're not cutting. They don't have the balance sheet to cut. Nigeria needed another $1 billion loan. They need the US dollars or the petrodollar to help backstop. And Saudi Arabia knows that. Saudi Arabia said, Saudi Arabia does not want to undermine these undertakings by backing further cuts at this stage, according to people briefed with the matter. And again, it's just looking at Saudi Arabia needs to protect market share, but at the same time, they understand that there has to be a certain amount of flow. So it's going to be hard to see these adjustments. And, we got some headlines saying, they're looking at the price decline. Again, they're not looking at the price decline enough to really say that they're going to take action, because action is going to be another problem, because you don't want to see additional cuts, because if you see additional cuts on pricing, then it's just going to go into another war, another pricing war. And again, the market just can't handle it at this point. Now, the refiners would love it because it would get crude at a cheaper price and would provide a certain amount of discount to the end user, but we just won't see that just because demand remains the problem. And that shifts to India when we look at this high frequency dashboard. So India August oil demand, we talked about how we thought the oil demand was going to be down 17%. It was down 16.2%. We thought gasoline demand was going to be down 7%. It was down 7.5%. We thought diesel demand was going to be down 21%. It was down 20.7% year over year. So we were close. We were getting there. And these high frequency dashboards really kind of drive home the problem in terms of new COVID cases. They set a new record today. So they're now back over 500,000 on new cases. So the new active cases is going to go back up. So this hasn't been updated for the 9th. This will get even worse when you think of the virus overall. The lockdown index is going to remain at about 81, 82, which again is coming back down to lockdowns. We talked about 50% of the trucking capacity offline. This is going to remain a problem. Consumer sentiment remains down 43, at about 43%. That's going to, again, be a huge issue when you consider how's the consumer spending. Exports remain soft, imports remain soft, and you're seeing more and more product get put onto the market because they're not consuming it domestically. We've seen refiners go from 87 to 92%, and in some places 95%, back down to 60, 70, 80%. So again, we're seeing that loss of oil demand within India, which is putting more on the water. So now you could say, well, what about South Korea? Because we're seeing a little bit of a normalization there. But as we talked about in our economy show, South Korea, Samsung, and SHANGHAI has said that they will stop ends all supplies of semiconductors to Huawei. That comes down to the fact that the U.S. put sanctions on specific on Huawei and anybody that supplies them. So obviously to Samsung and the other companies, the U.S. is a huge market. You don't want to lose the U.S. market. So again, this is going to be a problem when you start to think about overall trade within Asia. So the other thing that we've talked about is South Korea has seen its own increase in COVID cases, which now the stringency index hasn't really done too much. It's kind of hung around that 50 level, but it has created a big slowdown in retail sales and recreation as people, again, not that they're being forced to, but consumers are willingly adjusting their movements. They're just because they want to avoid contagion. They want to help mitigate the growth of the virus, which is an inherent problem when you consider where things are going overall. As we talked about in the economy show, looking at exports, imports. Again, this is all oil demand. This is all demand that is just not appearing in Asia. And if you think back to the bullishness in the energy markets that permeated through May and June, was that you were going to get an increase in the demand. And you can see based on the high frequency data, you saw some of it, but as we kept guiding to, we saw cracks, we saw issues across the board, and it continues to remain the case. Now, when we go forward and we look at the Asia crude floating storage, you can see where we followed it the whole way up, and we said, look, it's going to hang out here because there's a lot of headwinds. Now, the market didn't care, June 5th, July 5th, September 5th, but then they cared September 5th. And now all of a sudden, this is coming to play, and it could be because we're now in the shoulder season. Again, favorite term. So now that we're in the shoulder season, you're seeing that, okay, well, how are we going to get through some of this spare capacity? We have not only onshore, offshore, how are we going to get through some of this to start whittling down the global oversupply? And that's where some of this overhang and these concerns are being priced in. And now just kind of rounding it out when we look at West African pull, because West Africa is going to be an interesting place when we start looking at the storage of refined products and oil, because again, this remains kind of a dumping ground for gasoline, and we're starting to see these slow builds in terms of floating storage. And it's something to watch, because as that increases, you're going to see more deferrals, more slippage, and that's going to put pressure on Middle Eastern crude, because most refiners would choose to buy a West African grade versus another grade just based on the medium sweet nature of that oil. So as that increases in supply, you're going to see additional pressure within the physical market. Now that's going to put additional pressure on Middle East, which is why we want to look at West Africa and what they're pulling through. So the fuel flows to West Africa, this is coming from Europe, has increased to a 5-month high. And it's not so much because we're seeing the demand, it's just we need a place to put it. We need a place to move it out of the market. And that's why we continue to see this pressure. Now we can round it out with some of the supply growth. And Guyana has been a big one just because we continue to get these big exploration finds, and it's been a growth prospect for a lot of different companies overall, specifically Exxon being one of the largest in some of the growth there. Now, we continue to see big finds. There's more to be had. There's some individuals, companies are very excited because a lot of this, if you see the line in which the oil finds go in terms of, if we look at northwest to southeast, you see right along this line. So there appears to be more in other countries. Now, the issue is always going to be political. What is the stability of the nation in which the finds are? Can you come to some sort of tax agreement, revenue share? But again, the size and quality of the crude remains a positive within the market, because you hear a lot of individuals talk about the supply shortfall, lack of investment, and that's going to decrease the pipelines, and you're going to see oil demand growth without the supply growth to match. Well, here's just an example of where we continue to see a lot of finds. Again, it takes years to develop a lot of these things, but as we see some of the current facilities turn on, especially with Exxon spending money not only on production facilities but also tiebacks and other infrastructure, the ability to essentially turn new wells on will shorten, because once you have the main infrastructure implemented, it's much easier to tie back, and it brings the overall cost down, because you just are spreading the cost across more barrels of oil and really utilizing and maximizing current infrastructure. So this is just an example of some of the oil growth that we think is prolific, not only in size, but also in scale and quality. So these are some of the important things to watch, especially as you see more money getting invested in the offshore market, because the offshore market is going to be very interesting when you consider it's low decline, has better quality crude. When you look at new refiners coming online, specifically in Asia and the Middle East, and just the type of oil that they require, which is on the heavier side. It can be sour, it can be sweet. That isn't as important as just the inherent gravity, which is why some of this oil will see a bid in the market and should trade at a premium, which again will help incentivize additional investment, because it's going to trade at a longer term premium, just given how the markets have shifted. So thanks again for watching. We had a busy week so far. We had our economy show. We have the EIA show coming out soon. And then we have our favorite, the primary vision frac spread count. Next week, and maybe this week, depending on how things look, we'll try to get something out on a China-India update, what's happening with food. And then next week, we're going to have another exciting lineup with the talk on inflation in the US dollar. And then obviously our normal slate of EIA, economy, and then the favorite primary vision frac spread count. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.